Good morning, guys. So let's start. Today our topic is very interesting in the sense because every one of us is having some thing we are buying on lease. So leasing is our topic today. So that's why I'm saying it is interesting in the way that we buy mostly what we do. We buy cars on leasing and other things as well. Uh, so let's start our topic. I'm gonna start sharing that PowerPoint. So leasing is a way of getting some assets which we want to use for our business purposes. It's other names for leasing is hire purchase and all these things. Leasing is basically we are renting equipment or a asset for a certain period of time, and then later on we maybe there's a two possibility: either we can retain it by paying a price for it, or we have to return it to the lessee. So let's start lessor. We will return it to the lessor. So let's start what basically things what we're going to talk in this interesting topic. Understand the basics of lease and different types of leases. Know how accounting rules and tax laws define financial leases, and then understand the cash flows from leasing and be able to conduct a lease versus buy analysis. So that's the main idea of this chapter, is that whether we buy or we lease a asset. The reason this is important in my perspective is that we also do this analysis for our personal lives. Like if you want to buy a car, and then you have two options, like either we go for a financing or we can buy it on a cash, or the third option is that or we lease a car. So these are the things we going to talk in detail. Know how the lessee or lessor can both benefit from leasing. Understand the good reasons for leasing and the dubious reasons for leasing. There are certain terminologies we have to use it when we're discussing the leasing or lease. So lease is a contractual agreement for the use of an asset in return for a series of payments. That's what we call it as a rentals. So it's a contract. It's a contractual agreement, means a contract between two parties. One is a lessee and the other one is a lessor. The one who is getting the asset for use is called lessee, and the one who is providing this asset for the use is called as a lessor. So lessee, a user of an asset or make payments, and then lessor, owner of the asset and receives payment. So this is what we call it. Direct lease. Direct lease is when the lessor is the manufacturer. For example, Honda is leasing nowadays they are not leasing directly. They created a subsidiary for financing purposes. But if the manufacturer is leasing directly, that's what we call it as a direct lease. Captive finance company subsidies that lease products for the manufacturing. That's as what I said here. Now, this is a comparison that how it works. Like if it is a buying and if it is a leasing, that's what's the difference. So here is a good thing that you can understand. The Canadian enterprise buys asset and use assets, financing raised by debt or and equity. So the finance can be a debt or equity, but the firm is buying or the business is buying an asset. Now, in that case, what is going to happen? It's a manufacturer of the asset transfer the asset to the Canadian enterprises, and Canadian enterprises arrange financing and buy assets from the manufacturer. And what is the right for this Canadian enterprises? They can use that asset. They can also own that asset. So these are the two qualities that when you buy an asset, you can use it, you can own it. But in a lease, that's a Canadian enterprise lease assets from the lessor. The lessor owns the asset. So the manufacturer of an asset lease that asset to the lessor, to the lessee. Lessee has a right to use that asset, but does not own it. On the other hand, the lessor has no right to use it, but they own it. Own assets, does not use it. So lessor and lessee, there is a relationship. We call it as a lessor and lessee, and this is a legal language when we use this uh, uh, in different contexts like trust and trustee, uh, payer and payee. So these are the terms we use in a legal language, and same is the case here because the legal agreement between the lessor and the lessee. Lessee is the one who is getting the asset and making payments, and lessor is the one who uh, provided the asset and get the payments. Now there are two types of leases, and very broadly we can differentiate them very clearly. One is called as an operating lease, and the other one is called as a financial lease, and also called as a capital lease. Now, what's the difference? Operating lease, the ownership is with the lessor. The lessee is only using it. For example, if you rented a house, now this is again a lease agreement, and lessor is the owner. Lessor receives the rent, and you as a lessee, as a tenant, what you do, you make payments and you use that. At the end of the contract, you give back the house to the lessor or the owner, and you vacate it, right? So this is what we call it as an operating lease. It's an only operational. But there are certain types of leases in which there is a financial lease. Like you buy, you are not buying an asset, but you are leasing it. But at the end of the day, it is possible that you can buy that asset by making certain payments to the lessor. Now, operating lease, short-term lease, lessor is responsible for insurance, taxes, and maintenance, and often cancelable. For example, you rent a car, you rent a house. So these are the examples of a short-term lease. Short-term operating lease. These are the operating lease. Financial lease, on the other hand, long-term lease, like you take a car on a lease from a dealer. Lessee is responsible for insurance, taxes, and maintenance. Generally not cancelable, and specific capital lease, tax oriented and leveraged. Like it provides a leverage because the technique, if we go into the accounting technicalities of lease, uh, in operating lease, the lessee is not reporting this asset as an asset or neither reporting as a liability. So it means that there is no disturbance of debt and equity ratio. So there is a leverage that they can borrow more money, even they are using an asset on lease, but there is no disturbance for their debt equity ratio. So there are these technical issues we're going to discuss in detail, that what are the benefits that a lessor or a lessee can enjoy with the leasing. Sale and lease back. That is also possible, that you sell an asset if you need some finances, you sell your asset and take it back on a lease so that the asset is still in your hand. You can use it, but you can generate some finances as well for other purposes. So financial leases are essentially treated as debt financing. Present value of the lease payment must be included, but financial, that's what I gave you an example, that we cannot report it in the our finance in our books, accounting books, is the operating lease. Financial lease, yes, we have to report it. Financial lease are essentially treated as a debt financing, and present value of a lease payment must be included on the statement of financial position as a liability. Same amount shown on the left side of this statement of financial position as an asset. Operating leases are still off balance sheet and do not have any impact on the statement of financial position itself. Criteria for a capital lease or if one of the following 8 criteria is met, then the lease is considered as a financial lease and must be shown on the statement of financial position. So these are the 8 characteristics. If any one of it is there, then you have to report it as a financial lease, not as an operating lease. So you cannot keep it as off balance sheet. You have to report it in your financial statements. The first one is the lease transfer ownership by the end of the lease terms. If the agreement is like this, that the asset is automatically going to be transferred to the lessee at the end of the lease agreement, then this is not a operating lease. This is a financial lease, because the payments you are making must have a portion of your capital, your principal amount payment or the price of the asset payment. So that's why it is not treated as a operating lease. Lessee can purchase assets at a below market price. If this not automatic transfer, but it is like at the end of the term, the buyout option is available that you can buy it at this price, which is less than the market price. In that case, it is also not treated as a operating lease. It is a financial lease. Lessee terms is the major part of the life of the asset. Now, lease term is the major part of the life. Like if the asset has a life of a 5 year and if you lease it for a 3 year or a 4 year, so it is considered to be as a financial lease because after that the asset is obsolete. After that the asset is a scrap. There has no value. So salvage value is very little as compared to. The fourth one condition, present value of these lease payments is substantially all of their fair market value at the start of the lease. So the present value of a lease payments is substantially all of the fair market. So if the payments what they made so far is more than the market value of an asset, then we are considered is to be a financial lease, not. So the leased assets are specialized. If it is a very special asset, like someone is laying down a pipeline or buying a very specific machine which is developed on the request of the customer, in that case, it is not considered because there is no market value for that after that. So we can say that it is a financial lease, not an operating lease. Gain or losses accrue to the lessee. Like if that is the case, then we call it as a financial lease. The lessee can renew at a rent below market value. So if that is the case, it is also not treated as a financial operating lease. It's a financial lease. If the lessee can cancel the lease, the lessor's losses are borne by the lessee. So if there is a cancelability and the lessee agree that whatever the loss is going to incur, I will bear it. In that case, it is also treated as a financial lease, not the operating lease. So these are the criteria. The reason for this is that in accounting, we have a different treatments for financial lease as well as for operating lease. So it should be very clear that what type of lease you can treat it as a financial lease and what type of lease you can treat it as an operating lease. Leasing or lease purchase of an asset or getting an asset on lease is more technical in the sense because tax is involved. Lease payments, if it is operating lease payments are tax deductibles. And we know that if we buy an asset, then depreciations are tax deductibles. So these are the two challenges when we are dealing with the lease. In a lease case, in an operating lease case, the payments or the lease rentals you pay is tax deductible. And if we buy an asset, the depreciation is a tax deductible, right? So we have to see this in the context of taxes. So lessee can deduct lease payments for income tax purposes under specific circumstances. So lease must be primarily for business purposes and not just to avoid taxes. So the objective is not to avoid taxes, but to run a business. Does not apply to the conditional sales agreement if there is a condition that you can buy it after that. So lease cannot automatically acquire title of the property after payment of a. So these are conditions very similar to what we discussed so far. Is that the lease should be operating lease, not the financial lease. So lease lessee cannot be required to buy the property during or at the termination of the lease. Lessee cannot have the right during or at the expiration of the lease to acquire the property at a price less than the market value. So what is the benefit? Now we have to see the benefit of a lease by looking at two perspectives. The one is that how much money we lose because we cannot charge depreciation on it, and how much money we get it as a tax avoidance or a tax saving. We can, or we use the word proper in finance as a tax shield. So we have to see these two things. One is a tax benefit or a tax shield provided by the lease payments, and the tax shield we forego in terms of the capital, cost of capital allowance, CCA. So after tax lease, what is the outflow? Outflow is a lease payments, and these lease payments are considered to be one minus tax rate into one minus tax rate. So whatever we are paying into one minus tax rate, because tax is going to be saved. So we can say if there is a margin in the tax. So lost depreciation tax shield. So what we get it? We get it a tax shield in case of a lease payments, but we also lost depreciation tax shield. So depreciation into tax rate for each year. Initial cost of machine is an inflow, that if we are buying asset, so we have to pay cash, that is outflow of the cash from the business. So that is going to be saved. And then we have to inflow because we save the cost of purchasing the asset. Now, may have incremental maintenance, taxes, or insurance depending on the type of lease and whether the leased asset is replacing one currently owned. So there is an example, and this example is good to understand uh, this whole idea what we are talking about, that tax shield for uh, uh, tax for lease and for depreciation. ABC Corporation needs a new cars. The equipment cars would cost $10,000 each if purchased and would be depreciated at a CCA rate of 40%. So capital allowances 40%. They would help the sales force generate 6,000 additional sales per year for the next 5 years. No salvage is expected after 5 years. Alternatively, the company can lease the car with this payment per year. And payments are due at the beginning of the year. The marginal rate, tax rate is 40%. So the tax rate is also 40%. The CCA rate is also 40%. The payments are different, like 250 per year for 4 years. Sorry, for 5 years. And this is what we have to pay right away. Now we have to create a cash flow. Cash flow, how much the cash flow. So what is an incremental cash flow? So after tax, lease payments are 250, 2,500 into 1 minus tax rate. This is 40% tax rate. So in actual, what we are paying is 1,500. That's an outflow for 5 years, 1 to 5 years. So every year we're going to pay 1,500 actual. The in nominal terms we are paying 2,500, but in actual it's 1,500. What we are saving is that is 10,000. Then lost depreciation tax shield, which is this chart is making that. So initially in the first year, that the year 0, we have to, you remember the rule for depreciation we discussed in the first part of this course, like the course for Introduction to Managerial Finance, that half yearly rules apply. Like if in the year in which you buy an asset, you have to apply the depreciation on the half yearly basis. So we take 10,000 as a 5,000 and apply 40% on it. So the tax CCA capital cost of capital allowance is 2,000, but the tax rate is 40. So 40 of 2,000 is going to be our tax shield. Same is the case in the second year. We have a balance remaining is 8,000. 2,000 is already depreciated. So 8,000 multiplied by 40, that is going to be 3,200, and 3,200, the tax shield is 40% of it. So it's going to be 1,280. Same is the case with the down. So this is our tax shield, what we are getting by if we buy an asset and we can apply it to our accumulated depreciation or depreciation. So this chart is explaining that how we can get a cash flows. So the first one is inflow, because we are saving, we are not buying the asset. So this one is our inflow. Now inflow, but we at the same time, we're going to pay the lease payment, which is 2,500. So we subtract 2,500 from this. Then we have a payment shield, like I mentioned, that 40% is a tax saving. So we can say that's 1000 is going to be saved. And 800 we just discussed is a tax shield for depreciation. So that is also considered to be negative because we are not saying. So ultimately, when we calculate all these things, we get it like 7700 positive in the first year. In the second year, we have a negative uh, minus 2780. In the third year, we have a 2268. In the sorry, in the third year, in the second year, we have a 2268. In the third year, 1961. In the fourth year, we have a 1776. And in the fifth year, we have a 415. So you see, this one is only positive and the other all are negatives. So if without going into this discounting or making all in a present value, we can say that this is plus, all are negative. And if we calculate it, we can see that uh, it's around negative something, right? If I go it. So we see here, if we add up all this and then say without considering the present value, but we cannot ignore that present value and the future value concept. So we discount these with the rate of interest. Now, what rate of interest we should apply? The rate of interest we should apply is that if we borrow money to buy this asset, we have to pay a certain amount of money. But in that case, also you see that there is a tax benefit. When we pay interest on it, we have a tax benefit. So we have to calculate the effective interest rate by adjusting the tax benefit of the interest payments. So whatever the interest rate we can get it. For example, if it is 11%, for example, it's as in mentioned in your book. If it is an 11%, so 11% is not going to apply. We apply it as a 7.8%. Why? Because 11% into 40% as a tax deduct. So the tax 11 into 1 minus t, which is zero point 0.4. So 0.6 of 11% is going to be around uh, how much? 6.6%, 6.6%. So it's going to be 6.6%. So let's discuss in this context that whether we have to go for a lease or a buy. Now, the company needs to determine whether it is better off borrowing the money and buying the asset or leasing. Uh, so what we can do is we have to compute the net present value of the incremental cash flow. So if we calculate the net present value of the incremental cash flow, so we can see that appropriate discount rate in the after-tax cost of debt, since a lease is essentially the same risk as the company's debt. So we calculate it. So with the same example here, we see that it should be 0 if we want to find out which interest rate is an appropriate interest rate. So we see that it's going to be 7.8 if we use Excel to figure it out, this interest rate, or a calculator with the financial calculator to figure out with which I is correct here to make it equivalent to 0 or NPV 0. So that is the rate at which if we are indifferent between the buying and the leasing, but that is the rate where we are indifferent. Now, if the interest rate charge, like I gave you an example of 11% and after tax adjustment, if it is 6.6%, so then we see here, this is a negative 199. So this negative 199 means that buying is good because it's a negative net present value. NPV is negative, so this project is not acceptable. For example, now we are modifying it. Like we can negotiate with a leasing company that because this way we are not making money out of it. So why should we go for a lease? So can you give some concession? So if we are successful in getting a lease agreement with 2000, not 2500, no 2000. So in that case, if we calculate again the same table, what we did here, but the only change is that we are changing the lease payments, which is 2000 here, not 2500. So the rest of the things are same. However, the payment shield is going to be changed from 1000 to 800. And the tax shield for depreciation is the same. It's not going to change. So we see here that the net present value is going to be positive with 1,126. So in this case, if the offer is like this, offer 2,000 payments, then we say that it is beneficial. So now what we get, the rule is there that if the net NPV is positive, when we are comparing the incremental cash flow, then we can say that the lease is better. And if it is negative, then we can say that buying is better. Now, this for leasing, we use another word, and here you can see that it is not appearing as NPV, it is appearing as NAL, NAL, net advantage to leasing. We call it as a NAL, net advantage to leasing is appearing here. And it's the same idea of a NPV, but we are calling it here as a NAL or NAL. Uh, so consider the previous example, assume the firm's cost of debt is 11%. So we can figure it out that it is 6.6%. As I mentioned, that this is our tax rate, which is 40%. So the effective or interest rate is 6.6%. And when we do this, we can see that it is a negative NAL, net advantage to leasing. Now, should the firm buy or lease? So in this case, we should buy because it's negative. And then, as I mentioned, when we renegotiate, we can change, we can go to the leasing as well. So net advantage to leasing. So net advantage to leasing, NAL, is the same thing as the NPV of incremental cash flows for any project. NAL, how we figure it out, the NAL, that's important. When there is a little bit complex situation. So what we have to do, we have to find out the how much we need to invest or how much is the cash inflow or cash saving when we go for a lease. That's the first payment, minus the present value after tax lease payment, present value, PV. We have to divide it like what we did here. These are lease payments and we, sorry, these are lease payments and we divide it with that. Net, not lease payments, but net. Minus present value of CCATS, present value of cost of capital allowance and tax shield. So it's a present value of cost and capital allowance, cost of capital allowance, tax shield. This is PVCA, CCATS. And then if there is a salvage value, then we have to apply the salvage value as well. So if the NAL is greater than 0, means positive, the firm should lease. And this is the rule what we are discussing. And if the NAL is negative, the firm should buy. Now we see here very clear examples. And here we have a good example to see. So there is an investment of 800,000. Yes, it's again, so sorry, 10,000. So it's a $10,000 investment minus lease payment that we're going to make it payment. Tax shield, we save it, payment shield for lease payment. So we can get it like this. And then we have these lease payments and tax shields. And then we have these payments. Now what we have to do, 8,500 minus discounted this for a 1 year, discounted this for a 2 year, 3 year, 4 year, and ultimately we are getting this much, right? This is our present value of the tax. This is the present value of after tax lease payments, after tax lease payments. Now, the whole formula for calculating the NAL is that we have to calculate investment minus the present value of lease payments minus present value of capital, cost of capital allowance for tax shield. So we calculate it here. So this portion is the calculation of PVCCATS. So 10,000 into tax rate into CCA rate over capital interest rate plus tax rate into 1 plus 0.5 into interest rate divided by 1 plus interest rate, and minus the rest of the things are for salvage. Salvage value into the depreciation rate into the tax rate divided by the interest rate plus the depreciation rate into 1 over 1 plus interest rate raised power 4, because after 4 years, that's the salvage value. So we apply this factor as well. Now, the important thing here that what I want to highlight here that you guys should remember that the formula for calculating PVCCATS, and this one is for salvage value. So remember, the formula here is saying for, yes, this one, investment minus PVC minus PVCCAT, what I showed you, and minus salvage. So three things we're going to subtract it from the investment so that we can figure it out, the NAL, and NAL is the way to decide whether we should go for a lease or we should go for a buying. The rest of the chapter is more theoretically discussing the reasons, what are the paradox attached with the leasing, and what are the ambiguous advantages or not clearly. So if the lessor and lessee have the same effective tax rate, then the leasing is a zero-sum game. So whatever the benefit goes to the lessee, that is the cost to the lessor. And if we sum up, it's going to be zero-sum game if both are at the same effective interest rate or the same bracket of tax rate. The same bracket of tax rate, so then it's a zero-sum game. Yes, it's going to benefit when their tax rates differ. Then leasing has a benefit for both the parties. So the company in the higher tax bracket can benefit from being a lessor because they can use the CCA tax shield. And the CCA tax shields are worth less to the lessee because the lessee faces a lower tax rate. So in this way, that is going to be benefit like for because we have to apply the CCA over the tax rate. So if someone is at the lower tax rate, so the CCA is going to benefit less to that person. So income to absorb the accelerated shield in the yearlies. Good reasons for leasing: taxes may be reduced. That's a one reason, may be reduced. It's not 100% sure if we are already have a high bracket. So may reduce some uncertainty, yes, because by this way you are not uncertain that in the future what will be the price that you when you're going to buy your asset. May have a lower transaction cost and may require fewer restriction covenants. Like if you go for a financing, there are many different types of covenants add to the debt contract, but in a leasing that covenants are not added up in the contract. So may encumber fewer assets than secured borrowing, right? So there is no involvement of you need any asset against which you can borrow, in which you can place the lien or the right or hypothecation of the asset towards the financial institutions. Dubious reasons from leasing: a statement of financial position, especially leverage ratio, may look better if the lease does not have to be accounted for the statement. So if it is an operating lease, as I mentioned in the beginning, it is not going to affect at the ratio of your debt equity ratio. So that's going to give us a more leverage to borrow. So 100% financing, lease normally do not require either a down payment or a security deposit. So other reasons for leasing: circumvent capital expenditure control system set up by the bureaucratic firms. So these are the dubious reasons for leasing. And as I explained, that it is important to understand these all ideas of leasing. Leasing is a very interesting topic. In my own, I love to deal with these type of. So in the second part, what we're going to do is I'm going to solve the question. I'm going to solve the question, one very specific question related to either we go to buy or lease. So by this question, you get a very clear idea that how we can uh, uh, deal with that type of question.